Here's a word you're suddenly hearing everywhere in oil markets: contango. On the 11th of July, 2026, oil prices are clinging to a $60 floor, barely holding on after months of oversupply pressure. Traders are discussing contango not because the market is recovering, but because it isn't. When oil slips into contango, it signals there is too much crude supply right now, and the future looks better than the present. That's precisely where we are today, and if you want to understand what's genuinely happening beneath the headlines, you need to understand this one word. Contango means the futures price of oil, what traders agree to pay months from now, is higher than today's spot price. In a healthy, recovering market you'd see the opposite, which is known as backwardation. The fact that Brent crude has deepened further into contango is a bearish signal. It means the market is flooded with supply, storage costs are being priced in, and traders seriously doubt that demand will recover fast enough to drain the glut. Reuters confirmed just last week that the Brent oil forward curve has weakened further, with prompt supply swamping the market. This is the financial system's way of saying, we have far too much oil, right now. What brought us here? OPEC Plus output decisions combined with sluggish global demand have pressed prices down toward that fragile $60 floor. U.S. oil and gas drillers are visibly pulling back, choosing not to commit fresh capital in such a volatile environment, and when producers themselves stand down rather than expand rigs, that is a clear crisis of confidence. Natural gas prices are falling further too on a worsening supply outlook, meaning the pressure is across broader energy markets, not just crude. The Brent forward curve deepening into contango reflects this reality. The near-term supply glut is real, persistent, and nowhere near resolved. The impact is tangible and immediate. American shale producers are particularly exposed. At $60 a barrel, many wells sit right at the margin of profitability, which explains why drillers are standing down rather than expanding operations. For businesses dependent on stable energy costs, the volatility itself is the problem, regardless of the price direction. Contango also incentivizes traders to buy physical oil cheaply today, store it, and sell forward at higher futures prices. Clever in theory, until you factor in tanker charter rates and storage facility costs that are themselves rising. Energy equities felt the drag midweek too, with the Canadian TSX declining as energy sector losses weighed on broader indices. Then came Friday the 10th of July, and the picture shifted sharply. Oil prices rallied on renewed fears over Strait of Hormuz supply disruptions, one of the world's most critical choke points, through which roughly a fifth of all global crude trade flows. Any serious escalation there could flip the contango structure almost overnight, tightening available supply dramatically and sending spot prices surging above futures. Analysts are now watching two opposing forces: bearish fundamentals from the supply glut pulling one way, and a rising geopolitical risk premium pulling the other. The near-term outlook is genuinely uncertain, and that uncertainty itself is what makes this market so difficult to call. Here is your bottom line for Saturday the 11th of July, 2026. Contango is not mere jargon, it is a market signal. It is oil's way of telling you that right now, supply is outrunning demand, producer confidence is low, and prices are holding above $60 by a thread. But with Middle East tensions re-entering the picture in a meaningful way, this market can reverse course within days. Understanding contango gives you a genuine edge when interpreting energy market headlines, because right now, those headlines are moving money,